If you have money sitting in a 401k, you should watch this video because President Trump just changed the way that your 401k works. This new executive order is working to change where you can invest your money in your 401k and what types of returns you can see. That's why in this video, I'm going to break down the new 401k plan and what this means for your investments. On August 7th, 2025, President Trump signed the Democratizing Access to Alternative Assets for 401k Investors executive order. Right now, if you have a traditional or a Roth 401k, you have very limited investing options inside of a 401k. Most 401ks will allow you to invest in mutual funds and ETFs, and very rarely you'll be able to invest in some stocks and bonds, and very rarely you might be able to invest in some annuities in your 401k, but primarily it's just this right here that you can invest in with your 401k, but this looks like it's going to be changing. The executive order is designed to allow 401k investors to access alternative assets for better returns and diversification. Now, in the financial world, when you use the term alternative assets, it's kind of a fancy way of saying anything that's not in the stock market. So it's pretty vague, but then the executive order goes on to highlight 6 different types of potential assets they're looking to add into 401ks, and I'm going to break each one of these down. If you've been reading Market Briefs, you've already read about this. Again, Market Briefs is my free financial newsletter for investors, where every day my team is working to break down what's happening in the economy, housing, stocks, crypto, and global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning, and when you join Market Briefs, you'll also get access to my investing masterclass as a complimentary bonus just for joining. So if you'd like to get Market Briefs and my investing masterclass, all you have to do is click the link down in the description below to sign up for free. Now, for full transparency, this executive order is not mandating that you'll be able to invest in all 6 of these things inside of your 401k. What it's saying is that the Department of Labor and the SEC need to work together to figure out how we can add these types of things into your 401k. So they're going to see what they actually agree to add into your 401k, and then your employer has to agree to add these things into your 401k if and when they get approved. But alternative asset number 1 that this executive order highlights are private market investments. These are investments in equity, debt, or other financial instruments that are not on the stock market. Meaning, if this goes through, you could use your 401k money to invest in startups that are not on the stock market. It's much more risky, but has more potential return, because now you can invest in a company before it actually makes it onto the stock market if you get a good company. Or you can invest this money into loans, into debt, meaning you could get interest on this money if you choose to invest your 401k money into debt. The second type of alternative asset is real estate, and what it says is direct and indirect interest in real estate, including debt instruments secured by direct or indirect interest in real estate. So it seems pretty broad, but it's kind of hinting that maybe you'll be able to invest in physical real estate with your 401k. Maybe you can go and buy rental properties, or maybe you'll be able to get indirect exposure to real estate, meaning you can invest your 401k money into a real estate fund, or maybe even real estate debt, meaning lending your money to real estate developers and investors, and in exchange you would get interest. That's what it seems that this executive order is trying to say for your real estate investments inside of a 401k. Then we have number 3. This is the one that caught all the news, which is cryptocurrencies. Here's what it says: to invest in holdings in actively managed investment vehicles that are investing in digital assets. So based on that executive order, it does not say that you can invest this money directly into Bitcoin. What it's saying is that you can invest this money into a fund on the stock market, like an ETF, that gives you exposure to that Bitcoin or other cryptocurrencies. Number 4 is direct and indirect exposure to commodities. So this would be something like investing in physical gold, that you would be able to buy the physical gold with your 401k, or get indirect exposure to the physical gold, but maybe buying gold contracts through ETFs, giving exposure to commodities. Number 5 is an interesting one, and what it says is infrastructure financing. And what that means is that the United States government has a lot of infrastructure projects going on that they just can't fund, that they have to borrow money to do. And what this proposal is saying is that you could use your 401k money to lend to the United States for these specific infrastructure projects, and in exchange, you will be paid back with interest. The risk is relatively low because the United States government can just raise taxes to pay their bills back, or they can work with the Federal Reserve Bank to get money printed to pay their bills back. So you can imagine that when you get interest from the United States government, like a treasury, that because the risk is lower, the returns are also generally lower, but an interesting proposal for your 401k as well. And then option number 6 is income. More specifically, it says lifetime income investment strategies, including longevity risk sharing pools. Essentially, it's opening the door to more types of annuities that could pay out income through your 401k that you could invest in. Now again, this executive order is directing the Department of Labor to now work with the SEC to try to get as many of these things passed for 401k investments as possible. We don't know if any or all of these are actually going to be passed, but once they do get passed, that's when then your employer who is offering the 401k has to select these options for your 401k as well. And that could make the job market a little bit more interesting, because if 401ks start to change, well then people might pick specific employers depending on what they offer in their 401k as well. 2 of these alternative assets are especially interesting, more specifically real estate and commodities, because these allow you, according to the executive order, to invest money directly into an asset, not using Wall Street. And the reason why that's so significant to understand is because the entire 401k system has been designed to get your money parked with an asset manager, a money manager on Wall Street, and then your money is tied up there until you retire, because you can't pull money out of your 401k until you're at least 59 and a half years old, because if you do it before that, you have to pay a 10% penalty. But here's why that's interesting, because when you put your money in a 401k and it's in the hands of a mutual fund or whatever type of fund, and your asset manager is taking a percentage of your fees, they're getting paid no matter what, because they get paid when markets go up and markets go down if they're charging you on assets under management. And the reality is, if you have a 401k, you are paying fees. Unfortunately, 90% of Americans don't know that their 401k has a fee, but the reality is your 401k is charging you a fee, because when you put your money into that mutual fund, well, that mutual fund has an expense ratio. That is the fee for using that mutual fund. Now, over the last couple of decades, we've finally begun to see some of these asset management fees fall, but you should still understand what the cost is and how this could play a part into that. Let's assume that you're investing $1,000 a month, and you do this for 40 years, and you can get an average 10% return on your money, and you're paying a small little 1.2% fee. This was kind of like the standard fee not that long ago, but it might not seem like that high, just 1%. But the problem is, it's not just your money that's compounding, it's also your fees that are compounding, because you're gonna pay these fees every single year on every dollar that you invest, and every dollar that's sitting there, and every dollar of profit as well. So what happens after these 40 years is you're gonna see your money grow to $4.6 million, which is pretty good. I mean, I don't think anyone's gonna say bad things to $4.5 million, but the other part that you want to understand is that you're also going to be paying over the course of your career $1.2 million in fees to Wall Street, which means without the fee you would have had $5.8 million, but after fees you're now left with $4.6 million. Now, you gotta pay to get good services. I completely understand that, but this is interesting because the 401k and Wall Street have been very closely intertwined since they were created. But now there's a proposal that you could potentially invest money without Wall Street through your 401k, which wouldn't make those asset managers very happy, because your money with the 401k gets tied up. Because as soon as you put your money in the 401k, you can't take it out. Wall Street knows that the money is going to be there until you're 60, 65, 70 years old, and they're going to take this fee every single year for every year that your money is in there, and hopefully they'll work to grow the money, but you're going to keep paying these fees no matter what. So it's been a guaranteed revenue generator for them. And if now we start to see money go out of Wall Street from 401ks, that could change the game. So it's very interesting to see how this has been mentioned, but we'll see if it actually happens or not, because you got to assume that Wall Street would not be happy if money is going to leave their accounts and go into people's individual hands. Now, they might say, well, We, Wall Street, are the professionals, and we want to be the ones that are managing people's money for your best interest. But some people would say, well, I don't want to use Wall Street. Just give me the option to not use them. That way I can keep more of this money in my pocket. We'll see how this ultimately plays out. Yes, I'll be keeping you posted on Market Briefs, and I'll do my best to keep you posted here on this channel as well. But those are the things that I want you to think about. So it looks like there are some big changes coming to your 401k. We'll see if and when they actually come through. But if this does happen, it could change the way that you invest your money for retirement. It could change the way that you pay fees, and it can change the types of returns that you get, because it can allow you to invest in much other options, some of which are more riskier than others, which means it could give regular people the option to be more independent with their investments without the hands of potentially Wall Street. Again, we'll see what happens. If you enjoyed this video, the best thank you is to share this video with a friend. America is entering a debt spiral.
When debts rise relative to incomes on a chronic basis, right now for the U.S. government, it's almost $1 trillion a year that goes to interest payments. When you run a large deficit, you have to sell debt to do that. And when I calculate it, the quantity of debt sold to be sold is much